this cycle really just got started after that consolidation. But I think the leg started in 2024 when we broke above 2,000 and we quietly moved from 2,000 to 3,000 and nobody noticed it. In fact, when gold was hanging out at 2,000, a lot of analysts put sell recommendations on Newmont and Barrick because they thought that gold had topped and they didn't see any upside. And then I think when Trump won, a lot of people expected the gold to fall because the economy was going to boom and Trump was going to do all this great stuff about shrinking the deficit, making America great again. But now it's becoming more obvious that none of that was true. But I think this is a new leg. We spent really over 10 years. Remember, the first leg of the bull market was 2001 to 2011. Gold went from under 300 to 1,900. So it increased by sixfold, right? Then it really went sideways from 2011 to 2024. Gold traded between 2,000 and maybe 1,500, 1,700. I mean, it initially pulled back to 1,000. It got to 1,050 in 2015. So it held 1,000, went back up, but only made a new high briefly during the 2020 COVID crisis. It poked its head above 2,000, but then, it got chopped off and it went back down. But that's a huge base that we built around 2,000 as a floor now, because it was resistance. It was the ceiling. Now it's the support. And now we're just starting another leg, which I think will be at least symmetrical to the prior leg. So we had the move from under 300 to 1,900. Consolidation, that was a sixfold increase. If you assume we go up sixfold from 2,000, that's $12,000 gold. So I kind of, at a minimum, I think that that's where we're headed. But if we end up having a dollar crisis and a U.S. sovereign debt crisis, we can go a lot higher than that. And I think that there's a good chance that that's going to happen. You asked me what's driving this. It is the monetary and fiscal policy of the United States, which are disasters. And in fact, following the weak jobs report that we got today, and by the way, the jobs market has never been this weak outside of a recession. In fact, the last two times you had a labor market as weak as the one we got right now, it was the Great Recession of 2008, 2009 with the financial crisis, or 2020 as we were shutting the whole economy down because of COVID. So, the Fed has been mischaracterizing this labor market. Powell kept saying we have a really strong labor market. We have a really strong market. He was wrong the entire time. We have a weak labor market. And you would even see how much weaker it was if we had honest statistics. But we don't. But even with the statistics we have, we had outright job decline in June. We lost 13,000 jobs in June. The August number was just plus 22,000. Manufacturing lost 13,000. And the U6 unemployment rate, which is more relevant than the headline rate of 4.3, is 8.1. So we've got rising unemployment and inflation. The Fed said that the labor market was strong, but inflation is weak. They got it backwards. The labor market is weak. Inflation is strong. And I think that's really what's helping to drive the move in gold now and down in the dollar is the Fed is about to start cutting rates into rising inflation. And it's hard to imagine when they've done that before because inflation is above their target and rising, and they're going to cut into that. So it's the opposite of what they should be doing. Even though the economy is weak, inflation is strong. And that should be the primary mandate, is to get inflation back down. But they're going to abdicate that role because of the political pressure to try to artificially stimulate the economy, the housing market. So gold is going to take off from here. We basically just left the launch pad, and we got a long way to go. But the whole time that gold was going sideways for 3 or 4 months, gold stocks were quietly going up. Gold stocks went up 30, 40% while the price of gold traded sideways. And that's something we haven't seen during the entirety of the bull market because the investors in mining stocks have never believed the rally. They've been skeptical the entire time. They're finally starting to accept the fact that gold's not going to crash. But these gold stocks are not priced for current gold prices, let alone the future gold prices, but at least they're pricing out a crash now. People accept, okay, gold's going to be around this level, so we got to bid up these stocks because they're still really cheap, even though they're up better than 90% on the year. And gold mining stocks are the number one performing sector in the market this year, and they're hardly ever discussed. No one talks about them. I think Newmont Mining is the number one performing stock in the S&P 500. You know, the only gold stock in the S&P 500, and it's beating all the tech stocks. Yet, probably of all the stocks in the S&P 500, Newmont is probably the one that's the least owned. Well, I think that is going to happen. I think it's pretty clear. If you look at the main buyers of gold the past couple of years, it's been foreign central banks. Why are they doing that? I think they're preparing to replace their dollars with gold. I think gold is going to become the primary reserve asset for central banks. And that's going to be a game changer for the United States because the world is not going to need our dollars anymore. Well, if they don't need our dollars, then how are we going to buy all the stuff that we need? Because we don't produce it. And how are we going to finance our debt? Because we've been relying on foreigners to finance that debt because they have the savings that we lack. So it's a big problem for the U.S. But I think from a monetary perspective, you're going to see, I think, people utilizing gold using the technology that exists today, whether it's on-chain with, tokenized versions of gold, or whether it's just through proprietary closed systems where the custodian has the gold and just uses technology to allocate ownership digitally so that people can transact business, receive and make payments, send money and receive money using gold, right? Just like using PayPal or Venmo or any other, Zelle or any of these things. You can just use gold. You don't have to transfer your gold. If I wanted to buy something from you and you wanted me to pay you, a gram of gold for it, right? Whatever that is, 30, 40 bucks, whatever, right? I don't have to send you a little bit of gold in an envelope and mail it to you. If the gold is held in a custodian and I have it tokenized in my wallet, I can just email or text you the gram. And now the ownership of the gold goes from me to you. So now you own the gold, not me anymore. You've got it. It's in a vault. Now, if you want the gold, you can have them ship it to you. But why do that? Just hold on to the ownership receipt, because now if you want to buy something, you can pay with gold, because the guy that wants to sell you that, he wants gold too. Why would people prefer gold to dollars? Because gold holds its value. Why would I want dollars when I can have gold? It's like, why use the post office when I can send something by FedEx, right? The free market has provided me with a better alternative than the government, right? Why do people use Uber and Lyft? Because taxis are too expensive. Why are taxis expensive? Because the government provides the licenses and regulates them, and so they're expensive. The free market alternative is, well, I'll just call an Uber, right? So the equivalent of an Uber in the monetary system is gold, right? Gold is the free market's money. Fiat is government money, and it's lousy because it loses its value. The longer you hold it, the less it's worth. The opposite is true of gold. The longer you hold your gold, the more it's worth. So given a choice, which would you hold?
Get there.
Well, it's very realistic. I mean, especially if you have $10,000 gold, $200 silver, what is that, 50 to 1? I mean, so that's very realistic. And I think potentially silver could go higher than that. But right now it's above 41. It does have this psychological, and not just psychological, real resistance at 50, because we have a double top there that goes back to 1980. And then again, we hit it in 2011. So silver has not broken out yet. While gold has, silver is still in this range. So I do expect that it will, there'll be some overhead resistance. But I think once silver is above 50, once we're at 51, 52, and 50 becomes the support, I think it's not going to take long for silver to double to 100. I think that move will happen quickly. It may happen in a matter of months, right? Because once we take out that resistance, there's nothing there. And I think there's also a lot of shorts out there in silver that, are going to be in a lot of trouble trying to cover those shorts and buy silver that really doesn't exist.